Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to see what's going on with Twitter, see what people are sharing on social media. It's generally related to three topics: wealth building, financial topics, and or commodity related topics. Those are the big three that I cover. And we'll get in here and give you my financial opinions. If you want to follow me, it's at finding_finance. And if you want to join the website, it's finding-value.com. Where we talk individual companies and individual sectors. So we got Jay Henster here. You got what I need. I know I'm not a singer. It's okay. Time to shine. We do have a bullish engulfing on you got what I need. There is a support line coming across. We broke out, kind of did a little bit of a back test, came back again. We've got the stochastics turning up from a very low level. Here's your time to shine, guys. Here's your time to shine if that's what you want. Patrick says, when wages accelerate too fast, then that destroys the purchasing power of the US dollar even more. Last time they accelerated this fast, we were in the 1970s. Kind of a cool looking chart. We've got United States purchasing power coming on down in the red. We've got silver price, silver going bonkers in the 1970s. Along with wages accelerating. We had a long period where wages were not accelerating and silver was definitely not accelerating. Then we have another wages accelerating type move from 2018 onwards. And we've got a gigantic cup and handle formed right underneath the trend line. And that's also part of another gigantic cup and handle of the whole thing. The 7-year rate of change for purchasing power, you can see a big decline in purchasing power. So your purchasing power crashes, wages accelerate, and then silver goes bonkers. We've got that same type of situation. Wages accelerate, purchasing power crashes, and we're waiting for the launch sequence in silver. Countdown, 10, 9. Oh, sorry, guys. I didn't even have this all the way on there. There you go. Sorry. So I'm talking about this purchasing power decline and the wages accelerate on this side. And this is the silver cup and handle. It's a cup and a handle there. We also have a bigger cup and handle there. And we're waiting for that big launch to the upside. That's really what we're waiting for silver to launch there. Charlie says X keeps pushing the For You tab on its users, switching it to be default option. That means you're missing content from people you're actually following. So let's look at this, what he's sharing here. He's got the ratio. I don't know why this is off. There we go. The ratio, technology sector versus the S&P 500. And we are back to basically the 2000 bubble level for the ratio. You can see in 1993, 92, that's a great time to buy technology stocks. Another great time to buy technology stocks was when it was down here. And now it is very expensive. Everyone is piled over in tech. Good luck with that trade. Come on over. Katusa Research here. He says, gold enters the fourth dimension. Real yields are bond yields, which are those that are adjusted for inflation impact. For 15 years, there's been a correlation between the gold price and the real yield. As you can see in the chart, there are three distinct bubbles. In the red is the 05-07 pre-GFC era. This interestingly showed that higher real rates tended to be paired with higher gold prices. In yellow, from 2008 through to early this year, there was a strong correlation between lower negative real rates of return and high gold prices. If the past 15 years are any indication, gold prices are massively overbought using the real rate analysis. However, at least in the short term, the tide seems to have shifted. This past week, gold, albeit briefly, ripped to new highs all the way up to $21.46 per ounce. Yet typical drivers of gold price action were muted. The US dollar is essentially unchanged relative to other major currencies pairs. Interest rates have soared and inflation has cooled off. Theory says that this should be a bearish environment for gold. But recent price action says otherwise, as gold is up close to 200 per ounce for the year. Here we are now. This is gold price versus the real rate of US 10-year bond. And this is history. And these are 05, 07, 08 to 2023, and then here we are today. So there are some weird things going on in these different eras of time. Daniel says yield curve inversion does not always mean recession, but it certainly shows stagnation and monetary imbalances. So this is the duration of the 2s and 10s yield curve inversion since 1941. And this is in months. So the yield curve inverted for 4 months, 5, 6, 7, and so on. We are in 17 months of yield curve inversion. There's only been one time in history that's been longer than that, and that's 1978. So that's what we've got for the months duration in the yield curve inversion on the 2s and 10s. Bora, good old Bora. I have great respect for Kazatomprom's team. They have proven to be a very reliable uranium supplier. They have the highest free cash flow per share in the industry. But given the issue in the supply chain, especially sulfuric acid shortage in Kazakhstan, meeting guidance is almost impossible. And these are the guidances here. And you can see they've been underproducing guidance. I know that they came out recently and said they were going to produce all this uranium out in 24, 25. But they could have problems where they don't meet the quotas that they said they were going to meet, specifically to sulfuric acid. We've got COMEX uranium U3O8 futures soared a full dollar today to a new 15-year high of $82.75 a pound. It is up 70% year to date as the nuclear fuel continues to be the world's top performing energy commodity. Look at that chart, guys. It's just ripping. Ripping, ripping, ripping. We're probably too cheap. Probably not expensive enough. The USA is down 160 rigs since last year. The international rig count is up 68 rigs since last year. So international is up 68, Canada is down 3, and US is down 160 in terms of rig count. Now, when things go bad or when things slow down, that's generally when you want to start looking at investments, and rig counts being down could be something to look at. The Baker Hughes Nat Gas rig count rose by 3 to 119 rigs this week, still minus 34 fewer versus 2022. The smallest yearly decline since July. It's not like production isn't at record highs, inventories aren't bloated, and LNG projects aren't getting delayed. But you do you, producers. And this is the rig count. It's coming on down, but it is slowing, and it looks like it's trying to bottom here. So that's where I've kind of been watching for energy service companies. Like, you know what? We might be bottoming here at some point in the rig count. We've got Michael Guyad. He says, Biden wants to give 500,000 Americans money to buy homes. This also aligns with where we are at in the cycle. Government always tries to help people to buy homes. Here is that thing. I mean, they're going to start loosening up on lending standards. We're going to get a big, probably real estate bubble at some point. And I know people think that we're in one now. I don't think you've seen anything. I think there's going to be a big bubble that occurs over the next, I don't know, 2, 3, 4, 5 years, however long it takes to build all those homes. I've got Cameco priced in other assets. So CCJ versus Dow Jones, you can see that we are coming on up. It's looking fantastic, much like the last bull market. We're about, I don't know, halfway or something like that. Maybe we're like here, somewhere in this range there. We've got CCJ versus the M2 money supply continuing to rip higher, looking good, much like last bull market. We've got CCJ versus the S&P 500, and it is outperforming that. Looks exactly like last bull market. And then we've got CCJ versus the uranium futures pricing. And that's kind of on the more expensive side. So CCJ has a little bit of room to go up versus 2007, about 0.75. We're at about 0.54, so it can go up a little bit more room to appreciate against the futures pricing. But if the future pricing keeps going up, Cameco, I think, will at least meet it or beat it. We've got uranium still looking solid on the ratio charts. Uranium versus silver, just ripping here, guys. I know uranium's been up and silver's been down, but that's exactly where you gain your purchasing power. Uranium is gaining purchasing power against silver. It's gaining purchasing power against the S&P 500. You can see it bottoming and starting to come on up. We've got uranium versus crude oil. That's broken out of its downtrend line and ripping to the upside. So uranium's outperforming crude oil. And uranium is outperforming in the M2 money supply. It's accounting for the money that is in the system, and money is rotating into uranium. We've got the palladium to silver ratio. I threw this on here. We've got buy silver up here at these very high palladium to silver ratio. So when the ratio goes down, silver outperforms. Silver is outperforming as this goes down against palladium, and palladium is falling in price. We've got a strong buy palladium zone down here that we may come down and come into where either silver goes up and palladium stays the same, declining the ratio, or palladium continues to fall and then falls in that buy palladium zone. But I think we're getting real close. It doesn't mean it has to go in that buy palladium zone, but I think we're getting real close here and it's looking good. Maybe we have a little bit further to go. We'll see. We've got platinum ratios. I've shared a bunch of platinum. So platinum to gold, it's at 0.5, super cheap. You can see that we're kind of right at this support. But guys, 0.5, I don't think it's ever been this cheap in history outside of 2020 and where we are today. We've got platinum to palladium ratio, and that's definitely hitting to the upside. We are gaining momentum. We're at 1 right now. That ratio bottomed at 0.3 something. That's when I swapped my palladium for platinum. And I'm going to ride this up, and hopefully we get above 5. 5 is way up there. If we get above 4.5, 4.5 is a great time to be swapping metals. Very good time, and hopefully we get there. Then we've got platinum versus silver, and we are making some headway up. We've got a breakout, a retest on this trend line, and hopefully we can start working our way up, which means platinum can outperform silver. I think we're still early in this mix. If we get a slowdown in the market, maybe that delays this a little bit, but I don't even think the big commodity bull market has started yet, guys. It's like we're in the launching pad for a lot of these, and we just haven't taken off yet. But platinum's cheap against all the metals. We've got China's real estate market suffered an 81% drawdown from 21-22 and another 64% drawdown in 2023. And that's that demographic that's just working against them. This is the huge decline in their real estate market. And this is a double dip property market downturn after a short-lived reopening recovery. And there we are doing probably a double bottom is what I'm seeing. But it's a massive move lower, and that definitely doesn't help commodity demand over in China. They're trying to probably do stimulus and go through a recovery phase of the real estate market. The probability of a recession in 2024 is at levels only seen 2 times since 1960. What this is the probability of U.S. recession predicted by yield curve 12 months prior. So we are up there, and that was related to the other post that I had in terms of the duration or the length of the yield curve inversion. So it is inverted, and maybe we get a slowdown. Maybe we don't. All these guys are predicting all this stuff, but they haven't been right yet. It doesn't mean they won't be. China is experiencing a full banking system collapse with local government debts exceeding 13 trillion USD equivalent. 90% are in default. And 4 trillion in real estate losses. China only has 2 trillion in bank equity. US lost 800 billion in GFC. China's debts exceed those of the United States while their system has 400% more banking leverage. During the Asian crisis of 97-98, 40% of China's banking system was in default. China's PBOC has publicly declared a make-believe marketplace. So, and in terms of the United States, the U.S. has completely recapitalized bank equity post-2008. U.S. banking system is fully equitized and fortified to easily weather a recession. China's system has only really been organized this way for 20 years, and it's a disaster given their asset-to-equity levels. So China is going through a slowdown, and their banking system is hurting. Crude oil, we've got $72 Brent has been consistent support this year. Logical place to look for a bottom. But I do not expect a V-shaped move like we saw in March with first OPEC announcement. More likely we test and retest like the summer lows. Patience is key for oil here, in my opinion, according to Warren Pies. Be patient here, guys. We've got lots of support underneath us at around in the low 70s. And that's where I think we'll find some support. Gold, all eyes on the December close for quarterly chart confirmation to see if we can close above it. Maybe we get a retest back to this trend line and then a rip to the upside. So back in 2020, before the cup was complete, I forecast a handle was likely to form. This was that handle. All we need is a December close convincingly above 2000, and we get a big bull market confirmation, and the next target is activated. The breakout target is the next target is $2,700 if that does break the 2000 and close above it. U.S. shale production is not suddenly surging. This bearish narrative, we believe, is wrong, has been extremely damaging to sentiment, and is rooted in the EIA's recent inclusion of NGL production in their weekly reported calculation of oil production. He says, the more reliable EIA 942 data is only modestly above original expectations. So if we look down here, I'm going to skip all that, look at the graph. EIA begins to include natural gas liquid production and oil production in July of 23, and you can see the production numbers really shoot higher. So I don't know if what they're producing is necessarily the same equivalent data that they were before. So be careful when you start looking at some of these data, because they're including natural gas liquids. For anyone looking at oil in 2025 plus, Aramco CEO, he says, if you look at existing fields today and the level of maturity that we're seeing in conventional and unconventional resources, you're looking at a 7% decline, i.e. 7 million barrels per day has to be replaced each year to stay flat in terms of production. So we need to find and produce 7 million barrels per day every single day to keep the oil production flat at 100 million barrels of oil production per day. So that's where I'm going to end it there, guys. That's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website. We're running the question and answer session right now. You can jump on there if you like to get ask me questions, or for me to answer other people's questions and you just to listen. And that's for the finding-value.com website. You have to be a member in order to go on those Zoom calls. All right, guys, that's what I've got for today. We'll catch you later. This is Finding Value.